Hey folks, Phoenix here. So in the last two class, we learned about the markets, the different types of markets, the difference between investors and traders. So in this market, we are going to understand. So in this video, we are going to understand who moves the price, right? Who are putting their money in the markets and how much impact they can make in the markets. See, we know that if you want to buy some assets or some stocks or some pairs, cryptos, anything, okay, there must be a seller on the other side. So he can sell to you and you can buy from him. So that's how the buying and selling works in the markets. There must be a person. If you want to sell, there must be a person and he need to buy from you. Okay. When you want to sell in markets. Okay. So in this video, we're going to understand the different types of market participants and how much their potential, how much their power, the strength in the markets, and how much impact they can bring to the markets. Okay. So the first one is retail traders. The traders like you and me. We are the retail traders. So what we mean by the retail traders is it's like individual traders, the personal capital to a broker. We use the broker to invest. We use the broker to buy and sell. There's a middleman, okay, and that's called a broker. And we need to use that broker to invest or trade in the markets, okay, because we don't have that much money, so we can directly contact to the exchanges. Okay, here we use the brokers. Anyway, we can understand that later about that, the big fund players. So in this scene, how retail traders are investing. Okay, see, if I'm going to invest or trade in the markets, I have like a small capital. I don't have the much big capital. Okay, so we are the individual traders. A single person is trading by their own decisions, own emotional, own analysis. Okay, we don't have the supercomputers. We don't have like algorithms. We are not the HFTs, high frequency traders. We are the smallest money traders, the dumb money. We are the dumb money in the markets. Okay, so the first one is we are the individual traders. A single person is trading in the markets. Okay, we are just buying and selling, depends on our analysis, depends on our emotions in the markets. The next one is psychology driven. See, often influenced by the news, FOMO, or the emotions. I know that many peoples, I personally know some more peoples, they're buying and investing in the stocks by taking some advices from the news or some like a social medias like a X or some Twitter. Okay, Twitter and Thread, these are the platforms. Some people is going to give some advices. You can buy this, you can sell this. These are the exact buy price. Okay, the next one is FOMO, fear of missing opportunity. For example, the retail traders, they don't have the knowledge about the markets, right? Almost 90% peoples, the retail traders, they don't have the much knowledge about the markets. So for an example, if a stocks moves, if a stocks break out from here at the like 40 rupees, for example, if the stock is running at 40 rupees and it's given like a quick momentum at the 60 rupees and it comes to the 60 rupees, the retail traders are going to feel the FOMO, fear of missing opportunity. They're going to think that I already missed this trade from the 40 rupees. If I miss at the 60 rupees, maybe if it's reach the next 100 or 120, it's going to be like a big FOMO, the greed. Okay, they're going to feel the greed, and after that they're going to enter from here at the 60 rupees. It can move from here or it can reverse from here. That depends on the markets. That depends on the supply and demands. But at the same time, the retail traders are going to be in FOMO, the emotionally driven at this place. Okay, and they're going to invest from here. They don't have like a much knowledge about the markets. They don't have their own analysis, hedge or something, and they're going to enter from here by FOMO, fear of missing opportunity. The market impact. See, the retail traders are huge in the markets. We are like 100 people, not the 100 people, like 1,000,000 people for one institutional in the market. So who are the institutional? In the next slide, we are going to learn about the institutionals. We are the 1,000,000 peoples for one institution in the markets. Okay, which means we have the small capital. Okay, in numbers, we are the big numbers who are participating in the markets. But at the same time, when we compare this capital, the total capital that we invest in the markets, it's lesser than one institution. Okay, why it's like this? It means the institutionals, they have the big funds. They have in trillions and billions, but we have in thousands and hundreds as our capital. Okay, see, we are the individual traders. Some people are getting their salary, some people are getting their some profits from their business, and they're going to invest in the markets. It's going to be like in lakhs or in thousands or in hundreds in the markets. Okay, but at the same time, the institution, they have the big funds. How they have the big funds? It's not their own money. Okay, you can understand in the next slide. So I hope you get it right. The individual traders, the retail traders, they are in the big size. Okay, when we compare the size of that crowd, the retail traders are in big size, the big crowd peoples. Okay, like millions and billions of peoples are there. They invest in the markets, they're going to trade in the markets, but their capital is like very less compared to the institutions. Okay, the next market participant is institutions. And you understand one thing, right? We have the big crowd. Okay, we are the big crowd peoples, but we have small fund. So what you mean by this? A small fund can't move the markets. Keep it in your mind. We can't able to move the markets. If a market is moving from 10 rupees to 100 rupees, which means we didn't given anything at here. Okay, we are just going with the flow. We just going with the flow. Okay, like a fish. Okay, like a dead fish. Okay, that's it. And this movement is created by the institutions. Okay, institutions created this movements because if market is moving from the 10 to 100 rupees, which means it needed the billions and trillions of money, but the retail traders don't have much money. If all the retail traders is combined, okay, we don't have the much money, and every retail traders are not going to buy and sell at the same place. Each and every retail traders are going to buy and sell in different places, different analysis, different emotions works for different peoples, right? So that's it. We don't make any impact in the markets, but we have the huge crowd. Okay, the next one is institutionals. Okay, so these are the big players, these are the big whales in this market. So who are the institutions? I know that if you invest, if you're doing like a insurance, if you're doing mutual funds, and if you're investing in pension funds, and if you're investing in fixed deposit, this all the money goes to these institutionals. I know many people are not believing this, that they think that if they invest in the fixed deposit, okay, and the bank is going to give loans to some peoples, and when the bank is getting some interest, they're going to give you in that fixed deposit profits. Some people are thinking that. So this is how the fixed deposit works. But at the same time, this all the money goes to the institutional, and the institutional are going to put that money in the markets. They're going to make the big money from the markets from your money, and they're going to give the small amount of money from that profit. It's like they already collected in a ball, and you will get that from a spoon. Okay, in that profits. Hope you get it. It's I don't know what's example I can give from here. Just understand the institutional impact in the markets. See, it's the big fund traders, the big money that flows in the markets from these institutions. Okay, it's a banks, pension funds, and insurance firms. So this is like for the long terms, they're getting these all the funds. For example, if you're taking any insurance, or if you're taking a pension fund, if you're planning the pension fund from your 25 years old, for example, okay, and you just planning like, okay, when you're getting 50 years old, you're going to get that money, the pension funds. Okay, till that you're going to invest each and every month. It's going to be like even a $50, $500, even $1,000 each and every month. So each and every month you are giving your money to the institutionals, and this institution traders or the investors, they're going to put that money in the markets each and every month. Just consider like this: if 1 crore peoples, okay, if 1 crore peoples are investing in mutual funds, pension funds, and like anything, it can be like if they deposit in fixed deposit, okay, if they're doing fixed deposit, these are the things each and every month. 1 crore peoples, for example, every month they investing just 500 rupees, okay, just 500 rupees. It's like some people are investing like a 50,000, some people are investing each and every month like a 5 lakhs, 50,000, 5,000, something like that, even 10,000, 20,000, depends on their plans, depends on the terms signed, like the plans they're choosing. Okay, for example, if they're investing 500 and 1 crore people each and every month, which means the institutions is getting each and every month, how much is it? 500 crores, right? 500 crores each and every month this institutions is getting from the retail traders, from the normal peoples who are investing in these all the things. Okay, just imagine how big funds. It's not a big fund. Okay, the 500 crore is not a big funds. But just imagine if 10 crore people's investing in different plans, like a 5,000 plans, 50,000 plans, 5 lakhs plans, and some people are investing in fixed deposit like a 1 crore, 10 crores, 20 crores, 30 crores. These are the amounts, right, to secure their future. And this all the money goes to the institutions, and this institution is going to invest in the markets, and they're going to make the big amount from the markets, from this all the money, and they're going to big money from the markets, and they're going to give a small amount of returns to these all the people who are invested in these all the terms. Hope you get it. How the institutions is getting money from you, from your hand, and they're going to invest in the markets instead of you. Better trade, better learn yourself about the trading and investments, and do the investments at the early stage. Okay, you can invest in the equities in early stage after finding the good stocks, not from the recommendations by news, some influencers, these all the stuffs. Okay, learn yourself, and after that invest in the markets at the early stage. It will be better for you, it will be better for your future. Okay, anyway, the next one is they're going to give the massive volume to the markets. We already know that they have the big funds like a billions and trillions in their hand. Each and every month they're getting like a billions and trillions from the peoples, and they're going to invest this all the money in the markets, and they're going to create trends in the markets. So what is trend? There's a bullish trend, which is market going upside. There's a bearish trend, which is market going downside, and there is some trend that's in sideways. Okay, it's not moving upside or downside, it's moving continuously in a range. Okay, it's called the sideways. So these are the three trends in the markets, and these two trends is created by these institutions by putting thousands and thousands of money in the markets. Okay, the next one is long term. Usually they hold the positions for the months or the years, because they're getting each and every month your money, right? And you thought that we are safe, we investing this insurance, mutual funds, and these all the things, and we are getting money. We don't know how they're making money. Some people really don't know how the mutual funds, fixed deposit, they're getting the big funds. Okay, how they invest in the markets, what they're doing in your money. Okay, many people really don't understand these all the things. They just read the terms and conditions, how much returns you will get for the next 5 years, 10 years, if you invest each and every month, if you invest each and every years. These are the things, and these are the monies goes to the markets by the big institutional traders. I'm not saying that it's wrong things. It's a better thing if you don't have any prior knowledge about the markets. If you have some knowledge about the investments and tradings, better you can do from your money. Okay, that's it. The next one is they're gonna think for the long terms, the institutional traders. And some institutions like a hedge funds, they're gonna create the big impacts in a smaller time frame. We're gonna understand that later. The next one is HFT and algo firms. Okay, HFT which means high frequency trading. It's like they're going to put their orders within milliseconds, not a single order. For example, if I sit in front of screens, I have so much screens. Okay, even I'm going to monitor in my mobile phone when I'm outside. Okay, for example, if I look at some charts, look some like a forex space, cryptos or stocks, I'm going to take it as like a watch list. Some stocks, if I want to enter, and I'm going to enter when I'm getting exact price range that I'm looking to enter for the long or the short side. Okay, and I'm going to make some money if that moves according to my analysis. Okay, that's how I works. Even for a weeks, I'm going to put like a 3 to 4 orders, which means 3 to 4 trades per weeks. That's what I'm looking from the markets. But at the same time, HFD and algos, they're going to put like thousands and thousands of orders within milliseconds, within not even seconds, within milliseconds. Okay, by using supercomputers. By using what? Mathematical models and supercomputers. They use this supercomputers algorithms, and they're gonna fill each and every trades. If you want to buy from any range, if you want to sell from any range, they're ready to take your orders from the markets. Okay, from market price, by using spreads, these are the things. Okay, that's we are going to understand the market maker sections. So HFT means high frequency tradings, algorithms, firms, which means they're going to put the orders, thousands and thousands of orders within milliseconds in the markets. So that's how the liquidity is created. Okay, HFT is providing the liquidity and the volumes that needs the market move smoothly. See, we can't see the markets in gap up or gap downs when it's running. Okay, sometimes we can see the gap ups and gap downs in the markets. We're going to understand that in practical classes about these are the gaps, these are the terms and things. Okay, so just understand these things. If you open the market here and if it's closing, we can't see any gap between these movements, right? We can't see any gaps. Gaps means, which means if it's moving like this, we can see a gap from here, and then a gap from here, and then a gap from here. Market can't move like this in opening times, open to close. Okay, market always moves each and every prices. Market going to mitigate, or market going to touch each and every prices. Okay, this movements is created by HFT and algo firms. That's it. Okay, which means they're putting thousands and thousands of orders in each price range, and they're making a movements smooth in the markets. Okay, we're going to understand after this in practical classes about these all the things. It's all headlines we are going to understand. Okay, the next one, the market makers. It's like a middleman. If I know that many institutions are making losses. Okay, many institutions are making losses. Many retail traders are making losses. Almost 90%. 90% retail traders are making losses. Those who don't know about the markets, those who don't have some strategies, hedge things, the frameworks, these are the things they're going to make the losses. Okay, even our retail traders, even some institutions, they're making the losses. But the only guy they can't make the losses in the markets, the only one guy, that's he can't make the losses, or they can't make the losses, that's market makers. Okay, they can't make even a single dollar loss in the markets. So who are these market makers? Without the market makers, no one can buy, no one can sell the markets in the markets. So they are bringing the seller and buyer at the same place, and they're making money from this bid and ask, the spread capture. They're going to capture the spread from every entries, from every trades that you put in the markets. They're going to make the money from that. They're not going to invest in the markets. They're not going to dump or pump in the markets. They're not going to move the markets, but at the same time, each and every time when you put the orders, they're going to make the money from your orders. So how it works, let's understand here. If I buy some stocks at 50 rupees and it comes to 100 rupees, okay, so I'm looking to sell from here. See, I already bought from 50 rupees, right? And it comes to 100 rupees and I want to sell at this 100 rupees. So if I place my sell order at 100 rupees, it goes to the market makers, and market makers is going to find if there is anyone want to buy this stock from 100 rupees. Okay, and they're going to find the next guy who want to buy from here at the 100 rupees, and this market makers is going to merge with me and him. After that, they're going to merge this order, buy and sell order, and after that I'm going to sell from here, and this order is going to get this guy. Okay, in these transactions they're going to get the commissions that's goes to the market makers. So what the market makers do here, they're going to bring the buyers and sellers at the same place. If I want to buy from 100 rupees, and if anybody want to sell at the 100 rupees, they're going to merge with both. Okay, and they're going to get the commissions from here. That's called the spread. How they're getting commissions? For an example, if I want to buy it 100 rupees, right, I'm looking to sell at 100 rupees because I bought it 50 rupees. So I'm already make 50% profit in these positions, in this trade. Okay, so I'm looking to sell at 100 rupees, and the market makers is going to make my sell at 99.99 paisa, which means 0.01 their commission. Okay, at the same time, when this guy is going to buy my positions at 100 rupees, he will get these positions at 0.01, which is this 01 is their commission, which is equal to 0.02 their profits, market makers profits. Without market makers, no one can buy and sell. It's like a shopkeeper. Okay, it's like your nearby shop. Yeah, for an example, if you want to buy an iPhone, okay, an iPhone, you won't go to the factory, right? You won't directly go to Apple factory and you are going to put some orders, and that factory guys is going to make your iPhones, right? Instead of buying this, instead of going to the factory, you're going to a shop, nearby shop. Okay, so this shop consider as a market makers. So this shop guys is going to get the iPhone from the factory. The bulk orders get from the factory, and they're going to sell to you from the shops. Okay, they're going to keep the iPhones, keep the phones at the displays. Okay, how they're getting these all the orders, we're going to understand in the practical classes. That's how the candlestick is creating, by this bid and ask prices. Okay, we're going to understand in like a practical classes. It's just a theory classes. Okay, so I hope you get it. What works in the market makers are doing here, and how they're making money. They're not going to like buy or sell at the markets. At the same time, they are the big money makers in the markets. Okay, each and every orders, they're making money from here, from your trades, from your enter, from your exit. Each and every time they're going to make the money. Okay, the next one, hedge funds. Okay, this very dangerous peoples in the markets, because they're creating the volatility within short time. For example, if market's moving in a sideways, okay, if market moving in a sideways, which is like if market is moving in a range, they're going to create some strategies, they're going to create some traps at these places, and after that they're going to give a quick momentum or fake outs, and after that they're going to give the moments whatever. Okay, they're going to trap some more peoples at these places, and they're going to make the profits from these other traps. Okay, so what is fake outs, traps, liquidity? These are all the things we are going to understand in practical classes. Okay, just understand this one. The hedge fund peoples, they are the big peoples. One, two, three. Just understand this thing. The hedge fund peoples are really dangerous peoples. Okay, they don't look for the long terms. See, the institutions are look for the long terms, for the months, for years. These are the things. But at the same time, the hedge fund peoples, they look for a short term. Within a short minute, they're going to make the big profits from markets by using volatile momentum. Okay, a quick momentum in the markets within short time, and in that quick momentum they're going to make the profits. That's it. Okay, that's what the hedge funds peoples are doing. And where they're getting money, same like mutual funds, and pension fund and some individual investors. Okay, some individual investors, they're not going to involve in the markets, but at the same time they're going to give their money to these hedge funds, and they're going to use this money in the markets, and within short time they're going to make a big momentum by using this all the hedge fund, individual investors funds. Okay, and they're going to make the big money, big profits from here in the markets. And mostly the hedge fund peoples are trading in futures and options. Okay, in last class we already learned about the markets, different types of markets. In that different types of market, we already discussed about futures and options and CDFCs, right? CFDs. So at the same time, hedge funds peoples normally trade in futures and options, and here they're going to use the leverage. So what is leverage? Each and everything we already learn it, right? So they're going to use the leverage, and they're going to make the big profits from the market in a small capital, even a small capital, the hedge fund peoples. Okay, so return is focused, high returns regardless of the market direction. They're going to shake the markets within short time. The next one is volatility driven. They're going to make the big movements within short time. Okay, that's what the volatile. So these are hedge funds. Okay, the next one is commercial hedgers. See, we know that for an example, if you have the airlines, okay, consider you have airlines, some of airplanes, okay, and airlines, and you know that you need consistent oil from the markets, right? Oils to your engine, to your flights, each and everything, they need the oil. And you know that the oil price is going to be fluctuate each and every time in the markets. It's not going to be a single price for an year. Okay, the continuous year, it's going to be fluctuate each and every days, every seconds. So what you're going to do, you're going to do some contracts with oil companies. You're going to oil company and you do some contracts. Okay, contracts for the next 1 year, and you're going to do some contracts like for the next 1 year you're going to get per barrel for the $40. Okay, $40 for a barrel, which means it's going to be fixed for the year. If oil prices hike from here, you don't need to worry about that, because you already done some contracts with oil companies. Okay, they're going to give in that price only for you if you've done this contract. So that's called the commercial hedgers. They're doing hedge. Okay, and they avoid the big risk in the markets. Okay, for example, if it comes down, for example, if a barrel is valid for the $30 for the barrel, you're getting this price from the markets. You're getting oil in this price, $30 per barrel. If it's hike like a $70, $80 something, what's going to be happen? You'll get $40 for barrel. Okay, this is how the contracts works in the markets. This is how some peoples, they're doing hedging. Okay, price locking. It's like a price locking for the years. It's like a airlines is buying oil, or farmers is selling wheat to lock the prices. And the risk management is like no trading profits. They are not trading, they are not buying or selling in the markets, they are not investing in the markets, but at the same time they protect their business. If oil price, if they didn't done any contracts with the oil company, for example, and it's running at $40 per barrel, and after a month when the war is started in the world, for example, if any conflict, if there is any something that's happened in the world, the oil price automatically rise up, the shoot up. Okay, and after that it's comes to $60 per barrel, which means he need to increase his ticket price in his flights. So people are not going to choose his flights. Instead of, people are going to take the cheap flights. Okay, so he going to be in losses in his business, which means this commercial hedgers not going to invest in the markets. They're not going to buy or sell in the markets, but at the same time they do some contracts. Okay, and they're going to protect their business. That's it. Okay, the next one is, we already learn about the market participants who are moving the markets. Right now we're learning about the who are protecting their business, who are protecting the markets. The commercial hedgers, they're not moving the markets, at the same time they're protecting their business. And who are the market participants? The retail traders. Okay, these are the players are involved in the markets, who are buying and selling investments. These are the things they do in the markets. One is retail traders, the next one is institutions. Okay, the next one is HFT and algos, and the next one hedge funds. Okay, hedge funds, and the next one is market makers. Okay, these are the things that's participate in the markets. Okay, and hedge commercials, they're going to protect their business. That's it. They do the contracts. Okay, the next one is governments and the central banks. They also impact in the markets, but they don't invest in the markets. At the same time, they're controlling their money, they're controlling their valuations in that particular countries. Otherwise it's going to be economically collapsed, right? They're going to control their policies, the major policies, and they're controlling their money by getting devalued. Okay, by hiking interest rate, if they hike 0.5%, even a 1%, it's going to impact in the markets, forex market, commodities markets, in that particular stock markets. Okay. And the next one is FX inventions, which is like currencies. Okay, managing the strength or weakness of their currency. They're controlling the currency by getting devalued. They got in that controlling currency, they're controlling the economics in that particular country. They're controlling something that's related to the markets, and they're going to make an impact by cutting and increasing this interest rates, their country's interest rate, the bank's interest rate, these are the things. Okay, we're going to understand that's also moves the markets because of interest rate. That's called the FMC newses. Okay, we're going to understand in practical classes how we can trade in FMC news days, event days, these are the things. Okay, see, the next comes the exchange and broker. So they also don't invest in the markets, but at the same time, if you want to buy something, that must be listed in the exchange, and you can buy or sell from the broker. Okay, the roles of this exchange and broker here: the central marketplace where the assets are listed. For example, if you have a company, just consider, if you have some companies, we can just name it as ABC. You have the ABC company, and if you are the large fund of investors to your company, you're going to list your company in exchange. Okay, in an exchange, you're going to list your company. Okay, so after that, the brokers are going to bring the traders or the investors to this listed companies so they can invest in this particular company. See, you stand here. Okay, you're going to stand here. If you have the money, you can open the broker account, you can open the demat accounts, and you can put the amount in this broker, and after that you can buy some companies which is listed in exchange. Okay, the exchange, which means a marketplace, which is like just consider, if you have some like a goods and you need to sell that goods, it can be anything like a coffee, rice, whatever. Okay, if you rise something, if you farm something, and if you want to sell something, you must need to find the marketplace, right, where the people are coming to buy and sell, buy from you. That's a marketplace. So the marketplace is like an exchange. If a company needed some investors, they must need to list their company in exchange. Okay, so the exchange is going to connect with the brokers, and in that broker, people are going to invest, buy and sell. The broker is connected with the traders and the exchange. Okay, the broker is like a middleman. It's a broker, the broker itself, the middleman. Okay, exchange is company listed. Okay, and traders is standing here. If our traders needed some like a particular stocks, they need to open an account in broker, and they're going to buy from the broker. Okay, and this exchange prices is getting investors from this broker. Okay, this exchange means our particular company is getting this all the investments money. Okay, this is how the stock market frameworks works. I hope you clear, right? I hope you clear. Okay, it's like a simple basic things. That's what I said here. Yeah, the next one is exchange. Means there's like a two exchange in the markets. Sorry, in India, it's a NSE and BSE. There's total 80 exchange in the world. Okay, 80 exchanges in the world. Currently in India, we have two exchanges. There is extra one exchange is coming right now. I don't know what's name it is. I forget it. Okay, anyway, currently we have the two exchange, NSE and BSE. For example, if you have the company, you need to go to the exchange and you need to list here your company, and after that, the exchange is connected with the brokers. Okay, and people are opening accounts in brokers, and they're going to buy your shares from the exchange. Hope you get it. This is very simple. Okay, I hope you clear. It's like a framework that's running in the markets. Okay, it's not impacting the markets, but this is what the market is. Yeah, and the broker is gateway that connect traders to the exchange. It's like there is different kinds of broker. In the next class, we are going to understand how to choose the best broker. Okay, in next class. So in that class, you're going to understand the broker, hidden charges, the commission spread, slippage, these are the things, and how to calculate these are the things. And after that, we can choose the best broker for your tradings or the investments purposes. Yeah, currently the brokers, Angel One, Zero, the Upstocks, the forex brokers is like Xness. That's what I do in XM and Xness. Okay, different kinds of brokers, like thousands of brokers is out there. For example, if you want to sell some plots or if you want to sell your house, you can find like thousands of brokers out there in the markets. Okay, who are ready to sell, who are bringing some peoples to buy your house. Okay, this is the broker's job, the middleman. That's it. Okay, the exchange is like, it's a place, the market, it's a stock market. Okay, consider this as a stock market exchange. Okay, that's where the company is listed. Yeah, hope you get it. The next one, who moves the price? See, we thought that if we have the large people, we can move the markets. See, the retail traders are in large crowd. Okay, we have in lakhs and crores people are investing through the brokers in the markets, but at the same time we can't able to move the markets. We can't able to move the markets. If market is want to move even a single price, it need a big funds. The big funds is comes from the institutions. Okay, the institutional, because they don't use their own money, they're getting thousands, billions and trillions of dollars from each individual people who are investing in insurance, mutual funds, pension funds, and these all the funds goes to the institutions, and they're getting billions and trillions, and they're going to move the markets. Okay, error is like thinking retailers move the price, but it's not. Next is price moves only when the institutions order flow is enters to the markets. Okay, we follow the whales. How we can follow the whales? That's we need to do some analysis. We need to understand the frameworks. So after that we can do the analysis. Then we can follow this big whales. We can go with a 90% funds that comes from the institutions. We need to follow these institutions. Okay, in this video we're going to give some examples how to follow these institutions. Okay, the next one is the patriarchy summary. We're going to understand who are going to impact in the markets and which time frame we're looking. See, the institutions, they always look for the long-term growth, and they're going to create a trend in the markets for the long terms. We can see the market moves like this. So this movement is created by the institutions for the years, for the months, for the decades. They create the trend in the markets. Okay, the next one is commercial. The hedge fund players, they always looks for a small trend within short time, a big impact in the markets like this. Okay, they're going to give a quick momentum within short time. The next one is market makers. They always capture the spread. They're going to make the profits from the spread, and they're going to give the liquidity. They're going to merge the buyer and seller at the one place, and they're going to get the commission from here. It's called the spread commission. Okay, the next one is retail traders. Me and you are the retail traders. We have a small funds. At the same time, we are the big crowd in the markets, and we almost 90% people are doing F&O and CFDs. So in this case, we are not really investing in the particular stocks. We are not creating a wealth in the markets. At the same time, we are going to capture a big momentum. Our mindset is like within short time, we need to make the big money, big profits in the markets. That's our mindset. That's a retail trader's mindset. That's why we always go for the F&O, CFDs, these are the things. Okay, and we are going to make the big losses in the markets by using big leverage. Okay, how to use the leverage, that we're going to understand later. So our impact in the markets very low. We can't able to move the price. Okay, we can't create the trends in the markets because we don't have much capital, and each individual traders are going to buy from different places, are going to sell from the different places. But at the same time, the institution, they have the big funds. They can buy and sell from a single place. Okay, a certain place, and they're going to create the trend from here. Okay, the action identification, the action behavior. So what we need to do to avoid the big losses in the markets? See, we have like a $10,000 or even $1,000, and we can't able to move the markets, right? But instead of this, we can follow the footsteps of these institutions. How we can use the footsteps? We know that they have the big funds, and they can able to move the markets from here. Something breakouts and breakdowns like this. Okay, that's created from the institutions. So if market is giving a breakouts or the breakdowns or the big candles, which means that includes the big funds in that big candle, right? So that candle is created by the institutions. So we can go when we can see a big candles, the big momentum that's coming in the markets. Okay, we can understand in here. See this. This is a chart of GBP USD, right? See, this is a range, right? This is a box range, which means price is moving between this box, right? Price is moving between this box. Okay, instead of buying and selling between this box, when the price is breaking from here, see this, it's a big candles. Okay, this big candles, which means market need enough money to create a candles like this. But big candles means big funds, okay, invested in that particular candle. So in this candle, we are going to sell from here because we are following the big institutions. The big institutions is going to create the big candles, and always look for the higher time frames, like daily time frames or 4-hour time frames. Okay, because institutions are always looks for the long terms. They're creating the trends in the markets. Okay, see this. At the same time, it's a daily time frame. Daily time frame means a candle is getting created after taking 24 hours. Okay, that's how the daily time frame candles is created in the markets. So this is a range. Okay, after this range, we can see a candle close above this range, a big momentum candle, which means in this range, Many people are getting trapped, many people are investing in this range, but at the same time we move differently. We're always going to capture a momentum with the institutional traders, institutional investors. So this big candle that's created by the institutions, how it's the institutions created this? See, it's a range, right? If they need to break the range, if they need to create a big candle, they must need to invest in a big funds. So the big fund is comes from the institutions, and we are going to follow this institutional candle, and we are going to buy from here with the institutions. Okay, and we are going to sell from here in a small candle. After a big candle appears continuously, we can see a small candles, and after that we can sell at the small candles. Okay, it's not working like this. Okay, it's just frameworks. It's just basic. I'm just saying here. Okay, it won't work like this. We need to do some frameworks. We need to understand, learn some frameworks. So after the 10th classes, we are going to understand. We are going to jump into the practical classes. Okay, it's all the theory classes. Anyway, so that's how we need to follow the big players. We always looks for the big volume timings in the markets, big candles, the range breakouts, the range breakdowns. These are the momentum when it's a big players comes in the markets. Okay, and we need to follow them. That's it. So this is it. We understand the different kinds of markets, and we understand who are participating in the markets. So there's a question here is, are you going to be a retail trader, or are you going to be follow the institutional traders? You must need to follow the institutional traders if you want to make the profits, right? This is obviously everyone's mind. But before follow the institutional traders, you need to understand some frameworks. Okay, and see here, I know many people are selling their courses by putting thousands of names like ICT, SMC, these are the things. Let me tell you guys, even ICT created from the Michaels, right? And he is not revealed his PNL. Okay, he not revealed his PNL. And some people are there's a rumors spreading in the markets that he is in losses. Okay, he created some frameworks. This is called ICT. I'm not against the ICT or the SMC. I'm also using this liquidity concept, supply and demands concept. Before that, I was just using the support and breakouts, support and resistance. These are the things. Okay, just price action frameworks. So after I learned this SMC and ICT, I just figured it out to find the supply and demands when it's creating a FUG below or above the supply and demands, right? That's how we can find the available supply and demands. That's I learned from the Michael. Okay, he's ICT framework creator. His name is Michael. Okay, anyway, and I'm not blaming them, but at the same time, don't think like we can just capture each and every momentum with the institutions. We will get our stop loss. Okay, almost most of the time, but we need to follow the proper risk management. That's how we can be a profitable trader. Okay, after following our rules, we need to set the rules. We need to create our own hedge. Okay, instead of following someone's. And we need to create the strategy by using the frameworks. We are going to learn the frameworks in this masterclass. Okay, the frameworks means identify such a moves before it's happened. Okay, that's what the frameworks is going to do with you. And understand each and every moments when the price is going to reverse, when the price is going to continuation, when the price is going to take the pause. Okay, that's what we're going to understand in this framework. I hope you get it. Okay, in this practical classes, we are going to understand the analysis. Anyway, I'm not going to put like thousands of names, but at the same time, don't think that even a big institutions are using these charts. Okay, using these candlesticks. These are the things, because the big institutions are getting raw data, like how much people are enter from here, how much money or comes here. See, if we have the limited priority in the markets, we can use some like analysis. We can do some analysis, and we can find the good trade setups. Exactly, we can find some good trade setups, but at the same time, don't think that we also follow the every institution's moves. We can't able to possible that, because institutions are getting raw data, how much players are buying and selling at the same some places, and some people are saying that each and every time institutions are trying to take the stop loss of these retail traders, trapping the retail traders. No, it's not. Okay, let me tell you why. For example, if you are a retail trader, okay, the price moves from here, right? We can consider this is 100 rupees, and this is 200 rupees, and this is 300 rupees, and just consider there's a 10 people. Okay, 10 people learn from me the same frameworks, and they're going to trade in the markets. Okay, the 10 people are going to enter from the different places, right? The 3 people are going to enter from here, the 3 people are going to enter from here, the 4 people are going to enter from here. What's the reason? They're going to buy from this demand zone. Okay, it's a demand mitigation, and these 3 people are buying from here because of this breakouts, and these 4 people are going to buy from here. It's a demand mitigation. At the same time, it's a liquidity concept. They're going to use the different concept for the entries, for the frameworks. Depends on the knowledge, depends on the mindset, each and everything. And do you really think that these all the institutions are going to get this all the 10 traders money? No, right? These institutions work like that. Okay, these institutions are getting the raw data, like how much money is flow in this particular areas. Okay, they're getting raw data, guys. We don't have that priority to get that all, what I can say, raw data. Okay, see, for an example, if you want to buy some like a big things for the markets, for your tradings, for your investments, you can buy, what's that, Bloomberg. Okay, yeah, it's worst handwriting it here. Okay, let me tell you here. Yeah, here, just a second. Yeah, there's some terminals that going to provide you some like more knowledge, more insight about the markets. Okay, that going to give some like a more datas. If you have more datas, you have like a more privilege. So what is privilege? Which means you can use some more knowledge, some more datas, instead of following this 90% retail traders. So you can better be like a 10%, even better than this 10% retail traders. If you have a Bloomberg terminal. Okay, Bloomberg terminal. So let me tell you one thing. Okay, just wait. If you want this Bloomberg terminal, which is like some data they're collecting from the markets, and they're going to give you this terminal, so you can use this terminal and you can place the trades and investments according to this terminal, this data. You must need to do some analysis. Okay, and they have like a subscription for this terminal. Okay, subscription for this terminal. And do you know how much is their subscription? It's a $25,000 per year. Okay, which is like, in Indian rupees, it's a 22 lakh rupees per year for a single terminal, or for a subscription. Each and every year you need to pay 22 lakhs rupees to get that data. So what are the data? Data is like, if you trading in crude oil. Okay, if you're trading in crude oil, how we can do the analysis? We can go in trading view and you need to search. If you want to do some analysis about this crude oil, you can search the US oil and you'll get this. Okay, yeah, you'll get this oil chart. You need to do the analysis each and everything at here, and after that you can do the trade setups. You need to find the trade setups, each and everything, and then you can go for the trades. But at the same time, if you using this Bloomberg terminal, you will get some more data, like how much ships are moving in seas, in different seas. At the same time, how much ships is loading, how much ships is unloaded, how much countries order these all the oils. These are all the information, these are all the data you will get from this Bloomberg terminal. This is for the retail traders. Okay, and if you want this Bloomberg terminal, it's cost you around $25,000. Just imagine the power of these are the datas. And just imagine what are the datas these big institutions and hedge fund traders are using. Just imagine this. They're just looking at the charts. They're just looking at like a retail traders, where they're buying at the head and shoulder pattern, like a reversal head and shoulder pattern, like a triangle pattern. These are the things they're creating. These are the things. I don't know exactly what you're thinking. Okay, some like ICT and SMC people are just thinking. I don't believe in these all the things. Okay, because they're also getting stop loss. Even a price action trader is also getting stop loss. So what you become a profitable trader? What you need to become a profitable trader? It's a proper risk management, psychology, a bunch of rules. You need to set a rules for you. Okay, if you're a beginner trader, this video is going to confuse you. Don't worry, it's just a framework I'm saying here. Okay, you're going to understand, you're going to learn in this video. Throughout these are the classes, you're going to understand these are the things what I'm saying here. Okay, don't worry. And if you want to become a profitable trader, you must need some more things. Okay, not only some strategy, not only like analysis, the frameworks, the behind the scenes. You must need some more things to become a profitable trader. Okay, it's not about only the strategy, it's not about only the frameworks. There's a different frameworks. I'm not blaming the ICT and SMC at the same time, because more people are in profitable. But don't blame some like a price action trader, some indicators trader. See, I'm not using indicator, I'm not using any trend line patterns or something. But at the same time, I know some people are in profitable by using these all the things. It's about the experience, guys. Okay, that's it. And if you just search it in YouTube about learning trading for the beginners, there you will get the bunch of videos. Definitely you will get confused, which you need to watch, which you need to avoid. You won't get any ideas about these other things, right? Because you are just beginner trader. Some people are going to teach about the SMC, some people are teaching that these are the garbage things. You need some datas, the order books, order flows, okay, atlas, these are the things. I'm not against these are the things, but you need to give some knowledge from the basics. Okay, that's what you need to give. If you doing some like courses, because I already bought 4 courses in my early stage, in my early time, when I just enter to the markets, when I want to learn the tradings. But the 3 are garbage. Okay, 3 are useless for me. After I learned from these four peoples, then I realized that there's only one guy is teaching real trading. These three peoples are just core sellers. Okay, they don't even trade. They don't understand what the market is. They're just selling. Some people are just selling their courses by putting like a magic indicators. Okay, just imagine magic indicators. See, indicators can't works like that. Okay, I'm using ATR, average true range, just to understand the range, price range. These are the things I'm going to teach you. Okay, don't worry, don't worry about these other things. It's very fun, guys. Okay, some people are just putting their strategies like a magic indicators and like a no loss magics. These are the things. Okay, the name itself very fun, guys. Okay, market is won't work like that. Ready to hustle for the next 2 to 3 years if you want to become a profitable trader. Okay, if you want to become a quick profitable trader for the next 2 months or 3 months, if you want to become a profitable trader, it won't work for you. Market won't work for you like that. Okay, definitely it will take minimum 2 years. I'm saying from my experience and my colleagues experience. Okay, I teach them trading when I know everything, not everything, still I'm learning about the trading, still I'm learning about the markets, each and everything. Okay, it's like each and every day you need to collect the new data from the markets and you need to understand the markets. Each and every time the market is going to make a different moments. When there's like a conflict, currently the war is going on, there are different moments than usual right now. Okay, I'm not going to confuse you, but be ready for the next 2 years or the 3 years to become a profitable trader. It's not like a, what I can say, a jackpot in the markets. It won't work like that. Okay, if someone is saying you can be a profitable trader after buying our courses within like 2 months, within 1 month, and some people are selling that if you attend the 7 days masterclass you can be a profitable trader. I don't know how people are convinced for that. It won't work like that. Okay, that's it. Be ready, be prepared, and each and every classes you must need to be ready with the notes and write it on what you understand. Okay, after these classes just search in Google if you have some doubts, and if you watch this video in our mentorship, if you have some doubts about regard this masterclass, regard this uh what's this market participants, write it down your doubts and share that photo with our support team. Okay, they're going to clear you in our mentorship classes. Okay, so the mentorship, they will get the extra classes, extra benefits, live sessions, each and everything. I'm going to tell you the mentorship about the last class, in this last class. Okay, and if you want, the next class is going to be, we are going to select the best broker in the markets. There is like thousands of brokers is out there, and you need to calculate more things, understand slippage, spread, brokerage charges, and some commissions. And after that you need to choose the best broker to trade or invest, to create your accounts. Okay, that's going to be our module 1.4. Okay, and if you want to connect with me in social medias, just go and search on Instagram, Fynex. Okay, there you can connect me in social media. So here I'm going to upload my personal trades breakdowns and some educational videos in Instagram. At the same time, two YouTube channels. One is Fynex. Okay, Fynex. The next one is GREENZONE. So what's the difference between this? You will get the mentorship in these both channels. You will get the mentorship, the full mentorship in these both channels. At the same time, this channel I'm going to separately upload my personal trades breakdown. Okay, my personal trade breakdowns. So you're going to understand why you enter for a trade, what's the reason for the trades, and what you need to look before you enter for a trades. So you'll get understand some more things. Okay, it's my personal trades. And the next one is GREENZONE. In this you will get this mentorship also, and at the same time you will get continuous educational videos. Okay, educational videos in this GREENZONE. So subscribe these both channels, it's going to be useful for you. And there's a ebooks, there's a separate ebook. Okay, 1.3, this is extend ebooks. See this, it has the 38 videos, same like a market participants. Who are the market participants? And we explain each and everything briefly in this ebooks, so you can just download and understand each and everything. Say this, you must need to write it down. What you learn, you must need to write it down. Okay, and after that take this ebook and you can understand each and everything. See this, institutions are the whales. Okay, and impact, volume, impact in the markets, how much money they're gonna bring in the markets. Okay, the next one is banks and pension funds. Okay, retail traders are like a fleas. See this, the best example. Retail traders are like a fleas in the markets, and the big institutional traders are like elephants. We thought that we are just disturbing the big elephants. Okay, we are just buzzing around the elephants. At the same time, it doesn't matter if you buzz, if you do anything around this elephant as a flea. Okay, we are all the retail traders like a flea. I'm going to compare this like we are the cockroach and big institutions is like a whales. Okay, that's a big impact between the retail traders and the institutional traders, like traders and me and you at the same time. The big institutions, which they're getting big funds, the billions and trillions funds from the peoples. Okay, fixed deposit, pension fund, mutual fund, these are the things, insurance. Each and every money is goes to the big fund like institutions, and they're going to put that money in the markets. Okay, hope you guys get it. Each and everything we explained detailed, the brief explanation we provided at this ebooks. If you want this ebook, see this, each and everything. Okay, yeah. And if you want this ebook, we're going to upload this ebook in the description. Okay, in this video description. And if you're watching this in mentorship class, just message to the support team, okay, for this ebook, like 1.3 ebook. And if we didn't upload this in description, or you didn't get from the support team, just message me in Telegram. Just search it Fynex FX in Telegram, and you can message me there, and I'm going to provide you from the Telegram. Just message me there 1.3 ebook. Okay, this is a 1.3 class. The next 1.4 class is going to be like a choosing best broker. Hope you guys get it. Okay, this is what you learn in this classes. Anyway, let's stay tuned for the next classes and be hunger to learn. That's it. Hope you guys get it. That's it. Let's see you next class. Have a great day.